We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Mike Singleton, Senior Analyst and Founder at Invictus Research. Mike, thanks for joining me again today.
Thanks for having me, Tom. Always a pleasure to be here.
So, Mike, as a backdrop for today's discussion, can you remind us of the three cycles that you base much of your analysis off of and kind of where we are in each of them?
Sure. At Invictus, we are business cycle investors, and business cycle is kind of a generic term that people throw around a lot on Twitter and in Wall Street. But at Invictus, we define it in a specific way. We define the business cycle writ large as having three constituent subcycles: the real growth cycle, the inflation cycle, and the monetary policy cycle. And the reason we focus on those three subcycles is because really they drive the vast majority of the price action across asset classes. So stocks, bonds, commodities, currencies really trade on those three variables. I know macroeconomics and market strategy have a reputation for being esoteric and confusing and full of jargon. And there's a million different economic data points out there. There's plenty to confuse you if someone has an interest in confusing you. But the reality is, if you get real growth right, inflation right, and monetary policy right, you're going to get pretty much everything else right too. Right now at Invictus, the house view is that the US economy and really the global economy is reflating. That means faster real growth and faster inflation at the same time. And our view on monetary policy is that the backdrop right now is more or less benign. Historically, that's been a good backdrop for risk assets, stocks, credit, commodities, cryptocurrencies. And so that's how we want to be positioned right now.
Mm-hmm. So instead of looking at, let's say, GDP, as you mentioned, a million different data points, GDP is kind of a lagging indicator. How do you try to look, let's say, upstream of that to get a clearer picture of the health of the economy?
So GDP is okay. It has its limitations. It kind of lags some other measures of the growth cycle. It's very comprehensive, which is nice. It's a comprehensive measure of broad-based economic growth. So we still look at it. But obviously it does have its problems. And the way to get ahead of GDP is really to understand the business cycle and the sequencing of the business cycle. So big picture, how do you understand the sequencing of the business cycle? It really starts with interest rates. Interest rates in turn affect the housing market. We've actually had a very good case study in that over the last few years. In late 2021, the Fed started to signal that it was going to raise interest rates. Mortgage rates went from sub 3% to over 7% by the end of the hiking cycle. That immediately affects demand for homes financed with mortgages, which is almost every home, right? In the US, I think it's 85% or 90% of new home purchases are financed with the mortgage. So when mortgages become unaffordable, it puts downward pressure on demand for new homes. Housing activity actually drives a lot of other economic activity, one of the most important of which is demand for household durable goods. So these are big, expensive, discretionary manufactured items with useful lives longer than 3 years. So think cars, refrigerators, electronics, home appliances, like dishwashers, stuff like that. These are the things that drive the manufacturing cycle. So the manufacturing cycle tracks the housing cycle on, call it a 6-month lag. Manufacturing in turn, it has a lot of, manufacturing is a great leading indicator for corporate earnings, for GDP, for a bunch of other measures of the broader economic growth cycle. And the reason for that is it's very cyclical. So through historical recessions, call it the goods producing economy. So that's manufacturing and then a bunch of other stuff like mining, other cyclical economic activities like manufacturing account for 80 to 90% of all layoffs through a recession. So really the manufacturing economy and the housing market and these cyclical adjacent industries drive a lot of the business cycle, even though they represent only a fraction of the economy. And, that's the connection with the labor market as well, right? When the manufacturing economy gives out, that's what drives the big spike in initial claims, higher unemployment rate, and so on. And so if you can get ahead of GDP by understanding the business cycle in totality, you have a huge edge on really most of Wall Street and certainly most retail investors.
So when we think about how many, let's say, housing starts, and then how much that ends up kind of running downhill into these durable goods and stuff, how does the health of that sector look right now and the direction of that sector to you look?
So housing right now, I would say looks okay. If you in October of 2023, we saw interest rates sort of at their cycle peak, and then we saw a big decline in rates, into 2024, and that resulted in a boost in housing activity, right? We saw a spike in mortgage applications, we saw a spike in new home, we saw a spike in transactions closed, pending home sales, pick your measure of activity. Since then, the housing market has sort of stabilized, gone down a little bit, but you could say just broadly, it's stabilized. At Invictus, we think that the stabilization will be enough to keep the economy out of recession, even though the housing market isn't really a huge tailwind right now. The more important driver of the manufacturing economy, we think, is federal deficits, to be honest. In 2024, the federal government is probably going to run a federal deficit of about 7% of GDP. The historical average going back to the 1970s is about 3.7%. So we're almost, twice the size of a historical deficit. That's almost $2 trillion of de facto stimulus. The beneficiaries of a lot of that spending think about the Inflation Reduction Act, think about the CHIPS Act. A lot of that's going into manufacturing. So even though housing, which is historically the sort of primary driver of manufacturing, is tepid-ish right now, we think manufacturing will continue to do reasonably well, in part because of these significant deficits, of which the manufacturing sector will be a major beneficiary. And we're seeing improving manufacturing activity by a lot of different measures. The ISM manufacturing PMI sort of bottomed in late 2023 and has been improving since. The year-over-year rate of change in the FRB's industrial production data and manufacturing production data has been improving. A lot of the regional data has been improving. They all share a very close correlation with each other. So given that the momentum is improving and that we're not seeing any slowdown in government spending anytime soon, we think that the trend in manufacturing activity, the rate of change, is likely higher over the coming months and quarters.
Before we continue on this deficit spending versus manufacturing point, I just want to circle back to what we're talking about, this idea of consumption from the consumer, and that is obviously driven by new home sales and just home sales in general, I think. How do we kind of square that consumption with, the highs in consumer credit card debt right now? That's something that I think is a good indication of stress that the consumer is under. But how do you take that into consideration?
The consumer credit situation.
Mm-hmm.
So to be honest, I don't think that the credit card situation is particularly alarming right now on its own. Now, if you said, is the consumer doing well? I would say no, but credit card debt doesn't really factor into that. And the reason that I would say that is if you look at credit card debt over some measure of national income, like GDP or the personal income data from the Income and Outlays report, it's actually relatively low. It has been increasing since we've had this inflationary episode, since 2021. But, relative to certainly the great financial crisis or prior business cycles, it's pretty low. So, while I think that the consumer is struggling largely as a result of inflation and some bad government policies, I don't think that the consumer credit situation is necessarily the best reflection of that. And if you look at total consumer credit, it's actually down over the last, if you take credit card debt, auto loan debt, housing debt, all these things, it's actually down over the last few quarters, in part because people can't afford to have, they can't afford to buy a new car, they can't afford to buy a new house, rates are really high. So I think that there are affordability problems, but I don't think it's being reflected necessarily in credit.
Yeah, it's an interesting point to look at it versus these other metrics, right? Like as a ratio to GDP or other ideas like that. That's an interesting point that you bring up.
Right. Well, it's hard to say that the consumer is doing great because credit looks okay, when the reason there's no credit is because it's not affordable for most people.
Yeah, absolutely. But again, it's not just looking at it at the surface level of, being over $1 trillion in credit card debt, but rather the absolute level of what that means, and digging into it a little bit more, I think is important to understand.
Right. It's certainly interesting to see that the U.S., which has a reputation for being spenders rather than savers, has deleveraged significantly over the last 15 years.
Mm-hmm. So again, now
the private sector, that is, not the public sector.
Right. Yeah, absolutely. So again, now going back to this idea of deficit spending, I want to get your thoughts on how this is really targeted towards manufacturing. What do you see the effect of this deficit spending as having on inflation? Considering a lot of the higher wages in the West, will this offset in jobs created be a net positive once we factor in the inflation in prices associated with this change, do you think?
So in principle, when the government is allocating resources, it tends not to be very efficient if you're speaking as an economist. In other words, it doesn't tend to be GDP accretive. That said, one consequence of that is that it tends to be inflationary, right? We saw considerable stimulus in 2020 and 2021. And as a consequence, we had really high inflation in 2022 and 2023. So I'm generally a proponent of the private sector allocating resources instead of the government. That said, I think that it's important to make a distinction between what's good for consumers and what's good for investors, because all else equal, if we're just looking at price levels, higher price levels is bad for consumers. It makes things more expensive. It reduces their quality of life. It increases the probability of, rioting and political resentment and civil discontent. But for corporations, it's actually not bad, right? If you look at the correlation between corporate revenues or EPS growth for the S&P 500, it actually correlates very positively with, say, CPI inflation or PCE inflation. And all that correlation really means is all else equal, it's a good thing, right? It's a tailwind quantitatively. And so, we have to make this distinction as investors between what's good for the consumer and what's good for financial markets. And so deficit spending has long-term consequences and short-term consequences for the consumer, and they're not always good. But for investors, deficit spending is almost always good, unless there's some sort of offsetting monetary policy, but we're not seeing that right now. There's a couple of accounting identities. One's called the Kalecki-Levy profit equation. One is called the sectoral balances equation. And the takeaway from these identities is that whenever the public sector expands deficit spending, it creates wealth for the private sector, nominal wealth, right? Not real resources, but nominal wealth. And stock prices are quoted nominally and corporate earnings are quoted nominally. And so it's always, all else equal, it is always a tailwind for stocks and for corporate profits. And so, as investors, I think that's a bullish input into your investment process, not a bearish input. And, so while I think you have to respect that the impact on the consumer could very well be negative, I think as investors, we want to respect the fact that it's probably going to be a net positive and you want to position accordingly.
Mm-hmm. I think that's a really important point to consider, Mike, is this idea of kind of separating, let's say, the two groups of people that we would consider being affected by inflation. As an investor, and let's leave this idea to the side of this kind of reflationary effect on commodities, but as an investor, this can be a very, important time to have money deployed in an inflationary cycle like this. I think, over the last 3 years, I don't really think you can make an argument against that. However, it's a very different experience for the consumer at this point. If you're just looking at your grocery bill or your car payments or anything like that, right?
Right. Yeah, that's absolutely true. And just speaks to what I said a second ago, right? You have to make a distinction between what matters for financial assets and what matters in your life as a consumer. And I also joked with you before the show that one of the reasons that institutional investors tend to outperform retail investors over time is that it's easier for institutional investors who generally tend to have some money and have a high quality of life to get bullish because they think, hey, things are pretty good. Mm-hmm. And retail investors frequently, look around outside and they think, hey, food's getting more expensive. Maybe my quality of life isn't as good. And they have a hard time deploying the capital that they do have into markets. Even when the economic conditions for financial markets are supportive, and they end up falling further behind. So in our view at Invictus, our belief is that this is one of those environments where even though things are getting more expensive and inflation is accelerating, it's overall a good environment for stocks, credit, cryptocurrencies, commodities. And if you have an investment portfolio, you want to be invested to participate in that upside. You don't want to be invested in cash. Even a 5.5% money market fund that sounds really good, maybe it's even a 2 or 3% real return, but our expectation is that the S&P 500 grows earnings 12, 13, 14% this year. And we also, there's a dividend yield on top of that of about 1.5% for stocks. We think there could even be multiple expansions. So you have line of sight into 15 to 16% upside in 2024 for stocks. You'd rather have that than money market assets. You want to own assets in a reflating economy, risky assets in a reflating economy. And so that's something that we've been reiterating to our clients.
I know one of the examples you brought up before the show or before we hit record as well is this idea of the nominal returns in Weimar Germany at the time, right? You wouldn't be wanting to short stocks in that hyperinflationary environment. The real return of those assets is obviously going to be a lot less appealing than the nominal returns, right?
Right. And to be clear, I do think there are differences between the US, which is a sovereign issuer, and Weimar Germany, which had huge debts denominated in other currencies. But yeah, the joke is if you were an investment manager in Weimar Germany, you should not have been shorting stocks, right? You'd be the only person whose portfolio is worth less than having a bunch of Weimar marks under your mattress.
Mm-hmm. So as we're speaking about inflation, Mike, how do you compare this metric? Let's talk about CPI, for example. How do you compare that over time if the constituent parts by which it is measured keep changing?
So it's a good question. And I think you have to appreciate the limitations of CPI and the substitutions and the hedonic adjustments and all of these things that tend to put downward influence on the numbers over time. I don't think that you should not look at CPI or PCE. I just think you have to appreciate the limitations. Mm-hmm. Now, luckily, the US is a free market, and the market for global commodities is a very free liquid market. And so you have great transparency on commodity prices. So if you ever want to fact check on how inflation, really looks, is it going up or is it going down? Look at the price of commodities, look at the year-over-year rate of change, and that should give you a ballpark idea for what real inflation looks like, at least in terms of its direction, if not in terms of the order of magnitude, because services don't move as fast as commodity prices. And if you want evidence of that claim, just look at the CRB commodity index or even the price of oil in year-over-year terms and compare it to CPI inflation or PCE inflation. What you'll find is they look exactly the same. And in fact, commodity prices tend to lead government measures of inflation by about 3 years. So while I do think that government measures of inflation are biased low, I think that directionally they're right because that correlation is very, very high.
Mm-hmm. As we're talking about these kind of correlations, how do you look at income growth in America and a tight labor market? How do they correlate over time? And what does that relationship produce over time?
It's a great question. And it's one of the fundamental drivers of inflation right now. So Morgan Freeman famously said that inflation is always and everywhere a monetary phenomenon insofar as growth in new money is outpacing real productive output. That's a little confusing, maybe, probably not for your viewers, but for some people it is. I would simplify it and just say that inflation is always and everywhere a phenomenon of supply and demand for goods and services, right? So when demand is increasing faster than supply for goods and services, faster inflation, right? When demand is declining, where there's some kind of, where there's a productivity boom, that's deflationary, right? So the reason that we have inflation accelerating right now, just on the most proximate level, is that consumption growth is accelerating really fast and the real economy can't keep up. So why are we seeing faster consumption growth? A big reason is that we have a very tight labor market perpetuated by some of the fiscal policy decisions made by legislators in the US. But we have, call it, payrolls growth of 1.5% annualized and call it 4.5% wage growth. So 1.5% payrolls growth plus 4.5% wage growth gets you to about 6% income growth. Most of the time, Americans spend their income. So consumption growth is also about 6%. The real economy can only grow at probably 1.5% over time, but right now we're growing a little above that, call it 2 or 2.5%. That difference is inflation. Right now, it's about 3.5% by most government measures. And we actually see it continuing to accelerate in the coming months. So we think that inflation is probably going to accelerate toward 4% using, say, CPI or core CPI. And we think that real growth is also going to accelerate to call it 2.5%, maybe even a little higher, maybe 3%.
So as we're looking at these, let's say these higher prints of inflation of CPI, do you expect the Fed to kind of accept a higher target inflation rate, even if they don't, officially or outright say so?
I think that's more or less what they've done. And I don't hate the Fed, and I don't hate Jerome Powell. I think to my knowledge, he's sort of doing the best he can. But when you look at their policy pivot since December, basically what he said is there's a very high bar that they tighten monetary policy from here, and they're really looking to cut. If they get evidence that they can cut, they're going to take that evidence and run with it. So you have this asymmetric setup where hotter than expected data probably does not cause the Fed to hike, and cooler than expected data will almost certainly cause the Fed to cut. That's good for stocks, and it also increases the probability that inflation reaccelerates. And I think that underlying all of this, it's easy to blame the Fed and say that the Fed is bad. I think the big reason that we have inflation right now is not really monetary policy. It's monetary policy, right? We saw enormous deficits coming out of COVID. It's not really monetary policy, excuse me, it's fiscal policy. Okay. We ran really big deficits out of COVID. We're continuing to run basically a wartime deficit or a recessionary deficit right now, despite the fact that there's really nothing that warrants that economically. And when you're increasing the supply of money through deficits more rapidly than the economy can create real goods and services, that's always what's inflationary. The Fed doesn't really have anything to do with that. That's Congress, right? That's legislated spending. That's in part the Treasury in terms of how they, choose when to spend the money and distribute it and everything. But it's really Congress. The Fed is not monetizing the debt. The Fed is not even indirectly monetizing the debt through quantitative easing anymore. The Fed is selling securities. You could make the case that the Fed is trying its best to fight inflation, and it just doesn't have the tools because Congress is pressing the gas when they're pressing the brakes.
So, as we see these market expectations for a rate cut kind of dropping over this year, in this face of higher inflation, do you expect the Fed to cut this year, Mike?
I think it's possible that they cut maybe once if they get, like I said, maybe a couple of cool prints. That said, I think that, higher for longer is probably what we're going to be seeing for a while. And I think that the consensus is that will be bad for financial assets, right? Because, the curve is priced so that the market expects 1 cut, 2 cuts, 3 cuts, and that'll get priced out, and that will put downward pressure on stocks. And all of that's kind of sort of true. But the reality is stocks don't just trade on monetary policy. I think that in the short term, it's so easy to focus on what the Fed is doing and to say, the Fed's doing this or that, therefore the market has to do this or that. The reality is the longer term driver of markets is earnings, right? And earnings are driven by real growth and inflation. And right now we're seeing an upswing in earnings. Like we said, we expect 12 or 13 or 14% earnings growth this year. By our math, the Fed would have to increase rates 200 basis points to offset that increase in earnings growth and cause stocks to go down. That would put the 10-year yield at 6.6%. That's not going to happen. That's a really unrealistic outcome. So if we're right about earnings growth, what the Fed is doing is really, really secondary. And I think that for a lot of macroeconomists and market strategists, to say what the Fed is doing is secondary is like blasphemy, because all they talk about is the Fed all the time. Really, the US is a free market mostly, right? And has a very, very large productive private sector relative to every other economy in the world. And right now, that huge private sector is accelerating. And we think that's what matters most for stocks.
So, you mentioned the 10-year yield here, Mike. Are they more focused about what happens to the 10-year yield? And if so, why? Like, what is downstream of the 10-year? What does it affect?
It's a good question because the 10-year yield gets more attention from market strategists. But economists really tend to focus on the short end because the Fed talks a lot about what it's doing with the Fed funds rate. But the 10-year yield is actually the more influential rate, both in terms of financial markets and in terms of the real economic impact. The reason it's important for financial markets is, one, it affects bond prices. But two, it also affects stock prices because the discount rate for stocks is really closest to the 10-year yield. So, when the 10-year yield goes up, all else equal, that means valuation measures for the stock market tend to go down, and vice versa. The reason it matters economically is because the 10-year yield is the benchmark rate for the 30-year fixed mortgage rate. And like we said earlier, the business cycle really begins with interest rates and housing, and the 10-year yield is the most important interest rate. So the fact that we've seen interest rate stabilization after a period of interest rates going up really quickly, that's a rate of change improvement, right? That's a tailwind for the economy. And so we see that interest rate stabilization as monetary policy effectively going from hawkish to neutral. And, if the Fed cuts, that will possibly move it from neutral into dovish territory. And like I said, we already have an economy that's accelerating. If we get a neutral Fed will be enough for the stock market to go up. A dovish Fed would, really put gas on the fire.
Right.
We don't think that they will have the evidence to really get dovish because we think that the economy continues to run hot. But if they do, for whatever reason, maybe there's a political motivation, that's an upside surprise. It's not a downside surprise.
Right. So, as we're kind of talking about this entire, let's say, reflationary event, how does that affect commodities? How do you separate the buckets of commodities and their roles within, being defensive versus reflationary?
So, like all liquid assets, commodities trade on supply and demand. And I think you could make a case that they trade more purely on supply and demand than any other asset class. And the reason is because that there are commercial actors in the commodity space that there really aren't in the stock space, right? Everyone in stocks is speculating. You're not going to use a stock certificate to start a fire to keep your house warm, right? You're going to use it because you want to sell it later at a higher price. Commodities, on the other hand, right? There's commercial actors all over. There's caterpillars engaging in the market. Different miners are trying to lock in prices. Farmers are active in the grains market. There are people who want the commodities themselves for business reasons. And so it tends to trade more neatly on current supply and demand than any other asset class, stocks, bonds, currencies, whatever. And so it can give you really interesting real-time information on what's going on economically, like I said earlier with inflation. Mm-hmm. As it happens, commodity prices tend to be more sensitive to economic demand than supply because they have diversified supply chains, more or less, right? Copper has a different supply chain than oil, which has a different supply chain than palladium, which has a different supply chain than softs or whatever. So through historical reflations, when economic demand is accelerating and nominal GDP growth is going up, that moves the demand curve out for commodities and puts strong upward pressure on their price. So as a result, one of the quintessential features of an economic reflation is higher commodity prices. And it tends to be a time when commodities offer, a strong risk-adjusted return relative to other relative to other assets. And if you're worried that reflation eventually becomes stagflation, in other words, real growth rolls over, but inflation continues to accelerate, commodities offer immense diversification benefits. Now, at Invictus, we can't see out that far. I think there's certainly the potential for stagflationary risk in the coming years. So given that it's reflation, given that stagflationary risk exists, having commodity exposure in your portfolio is basically a no-brainer. I think you want to own some oil, you want to own copper miners, you want to own probably the, base metals themselves, aluminum, tin, copper, steel, and so on. The related stock exposures, so energy and exploration companies, miners, all of those are places that you want to be looking for opportunity, so to speak.
And let's separate those out kind of in those three buckets of defensive versus reflationary, if we could.
Sure. So you could divide commodities into a lot of different categories. At Invictus, we really focus on three of them: energy commodities, industrial metals, and precious metals. Mm-hmm. And the reason is because they're the ones that trade the most closely on economic data, so we can predict their price better and make better investment decisions. Ags is a little bit outside of our circle of competence. But essentially what you're seeing is energy commodities, and especially base metals, have had a pretty good 2024. And actually gold has too. So this is maybe not the best economic regime for this. But generally, when you see base metals outperforming precious metals and energy outperforming precious metals, that's a very good reflationary sign. Obviously, gold has had a good year this year, copper has outperformed gold. Copper has had an even better year than gold. And I think that, gold bugs sometimes overlook copper because it's not a precious metal and it doesn't have the same history as a store of value. But generally, if copper is outperforming gold, that's a good sign that the economy is reaccelerating. And it doesn't mean you can't own gold or overweight gold relative to other assets. But you might want to mix another metal into your investment portfolio there. I'll also add that a lot of times stocks, copper miners or gold miners will give you leveraged exposure to some of those underlying trends. So gold miners have outperformed gold, copper miners have outperformed copper stocks, and copper miners have broadly outperformed gold and gold miners. So that relative performance dynamic suggests that inflation is accelerating, but also real growth is accelerating, which is a time that you want to be taking more portfolio risk.
Mhm. Explain to us that dynamic again, if you could, Mike, or run us through that again, what you just said. The underperformance or overperformance of the base metal versus the miners.
So if we're looking at copper, gold, and their respective miners, copper miners have been the best performer, then copper, then gold miners, then gold. So what you're seeing is the riskiest, most cyclical groups are outperforming the less risky, more defensive groups. And when that happens, it's generally a result of real economic acceleration, economic conditions broadly improving. Now, in this case, gold and gold miners have still performed extremely well. So, my portfolio has significant exposure to gold miners because I still think it's a worthwhile exposure. But the signal is that copper is outperforming, which means, in terms of total portfolio and how you're positioned, you want to be owning productive assets. You want to own assets that participate in economic expansion. So you want to own stocks, you want to own cyclical stocks, right? You want to own commodities, you want to own credit as opposed to treasuries, you want to own, cryptocurrencies as opposed to cash. You want to be taking broadly more cyclical risk. You want to be owning things that broadly are participating in an accelerating growth environment, not things that are defensive. You don't want to be sitting on the sidelines.
So how does oil fit into that as well right now? What are let's say the headwinds and tailwinds or that balance on oil?
So oil trades very similarly to industrial metals, right? Because from a macroeconomic perspective, if GM is going to build a new car, they need all these industrial metals, but they also need, energy to power the factories. And that's a little bit of a simplification. But the point is the same. Look, when economic activity is accelerating, that means more demand for oil, because oil, like base metals, are an input into pretty much everything. Asphalt, cosmetics like lotions and lipsticks, polyester on your clothes. Oil is an input into literally everything. So when people are buying more stuff, they're almost always using more oil, which means upward pressure on the price of oil. Now, oil has traded down a little bit in the last few months, maybe less than that, maybe a few weeks. And that's kind of a little bit of a hole in the thesis. And personally, I don't have a great explanation for why it's traded down, because the inventory situation, the supply situation more broadly still looks very tight. Mm-hmm. But oil is a market where there is some speculation relative to other commodity markets. So, our view is that this could be sort of a hedge fund driven deleveraging. Generally, we're looking for opportunities to buy oil here. We think this is a buy the dip situation in oil. It's not the bottom's going to fall out and oil's going to crash. If it did, that would be extremely, bullish for stocks. So you want to have kind of a diversified portfolio, but that doesn't really make sense economically.
Mm-hmm. So when we think about, let's say, how you're owning these things, like you said, you have a good amount of exposure to the gold miners, for example, or you can use the copper mining example. How do you own those? Do you just buy an ETF like the GDX, or, do you buy individual gold miners?
Personally, I buy individual gold miners. On a stock specific basis, I'm sort of a disciple of William O'Neill and, the CAN-SLIM investment method. So you want stocks that are in a supportive macro environment. You want stocks that have improving fundamentals. Gold miners have all of those things. And then you also want stocks that are exhibiting strong trend and momentum. So, screening on a bunch of different things there. But some of the stocks that, some of the gold miners that we like at Invictus and have recommended to our clients in our weekly trade ideas product are Agnico Eagle Mines. I think it's AEM, Eldorado Gold Company, think it's EGO. And there are probably 2 or 3 more that we really like. We've been stopped out of a few of our gold trades, but on balance, the gold mining segments within our portfolio have done very well. It's been a sort of a top performing sector allocation, and don't really see any reason for that to stop. Gold miners have been out of favor for a very long time. They have a ton of room to catch up just to sort of reach parity with the spot price of gold. And so we're happy to continue owning them. Probably will continue to look for opportunities in that space until something changes.
Mm-hmm. So what would constitute, let's say, for you, an opportunity in that space? Or how do you base which of those miners that you want to be owning?
So, like I said, in terms of gold miners as an allocation, we think about macroeconomic conditions. In terms of looking at specific gold miners, we're looking at the underlying fundamentals, but then we're also doing a sort of a technical overlay. We want relative strength, outperformance relative to the broader market. We want positive trends, so we want things that are in uptrends, and then we want to be buying breakouts on supportive volume profiles. So that's really how we screen it. If you've read How to Make Money in Stocks by William O'Neill, that's really one of the most influential books that I've read at Invictus, and it's very influential in terms of, if you get our weekly trade ideas, you're going to be getting a lot of ideas that look, like the CanSlim, William O'Neill type base breakouts, and William O'Neill type risk management as well.
Mm-hmm. Interesting. So, Mike, when we're seeing economic data in other countries around the world slow down, especially commodity producing countries, this can lead to some of these central banks starting to cut rates. So how does rate cutting in countries outside the US affect the dollar?
So, in principle, if you believe in interest rate parity, then other countries cutting rates while we keep rates high is going to strengthen the dollar. I'd say at Invictus, we are generally bullish on the dollar, which is not a reflationary position. How can you be bullish on the dollar and also bullish on commodity prices or bullish on emerging market prices? And I think that part of the reason is the reason that the dollar is strong is because the US economy is doing well relative to other developed market currencies. So like the Dixie Dollar Index is what everyone cites when they talk about the dollar. The Dixie Dollar Index only measures the US dollar relative to developed market trading partners. So the Great British Pound, the Swiss franc, the Japanese yen, the euro is obviously the biggest weighting. Relative to all of those countries, the US has high growth and high inflation and very little reason to cut rates, right? In Europe, they have, slower real economic growth, and they actually have slower inflation in a lot of cases. So there's more reason for the ECB to cut rates. And if that happens, and we think it probably will at some point, that's all a tailwind for the dollar. That said, the dollar's actually been weakening against developing countries, right? Against emerging market countries. And the economic conditions in a lot of these emerging market countries have been much better. And that's why their currencies are outperforming the dollar. That dynamic where where emerging market currencies are outperforming the US dollar and developing market currencies is generally a very bullish reflationary dynamic. And we think that improving economic demand in the United States and in these emerging market countries, and we also think that Europe is probably going to pull through as well, that will be enough to sustain our reflationary thesis on a global level. Mm-hmm. Faster commodity prices, generally good performance from risky assets.
Mm-hmm. So broadly, Mike, do you think that investors are nervous currently about deploying cash? And how can that consensus give us clues as to how to position right now?
So yes, I think I talk with a lot of investors and a good mix of investors, some of whom are retail investors, some of whom are institutional investors. And I would say that generally speaking, institutional investors are apprehensive and uncertain and nervous about deploying capital, but willing to do so generally to remain at least moderately invested, slow to get overweight risky assets. Retail investors are outright bearish, at least the people that I speak with. Mm-hmm. And I think that that's a big risk. A big risk in a productive, generally successful economy is that you don't get fully invested through bull markets, right? And ultimately, I think that all of these bears will be proven wrong, and eventually they'll convert and become bulls. And historically, we know that price drives sentiment. So if you look at any measure of investor sentiment, the NAAIM data, the AAII data, the investors intelligence data, the retail sentiment data, the institutional sentiment data, it all correlates with price. So we think price is going to go up. In other words, we think people are going to get bullish. It's better to get bullish now, right? You want to own stocks before they start going up. You don't want to get bullish at the tail end right before the cycle turns.
Yeah, absolutely. It's, again, that kind of goes back to this idea of this market and this environment being good for investors versus being bad for consumers, or positive for investors and negative for consumers. It's not necessarily that you can really look at the entire picture without considering the differences for both, right?
Right. That's exactly right. And you have to be able to hold two ideas in your head at the same time, right? That there are a lot of consumers struggling right now, and the median consumer has trouble paying their bills and meeting rent. And that's not good, right? That shouldn't be normative. However, economic conditions are still supportive of higher, strong financial markets. And part of that is government policy, right? Like there are just a lot of policies in place that are basically tailwinds for financial assets, and they don't necessarily help the consumer. And as an investor, you don't win any virtue points for not being invested in the stock market when it's going up. You can and should help people if you make money in the stock market, but you have to make money in the stock market before you can give that money away, right?
Mm-hmm. Absolutely. Excellent, Mike. Well, that's all the questions I have for you today. Is there anything that you want to leave our audience to think about before we wrap up?
So at Invictus right now, we're developing a new mobile app, and it's going to have a lot of really cool artificial intelligence enabled tools, including a chat that's been trained on all of our data at Invictus and can essentially answer as a research analyst would. That'll be released in the next 30 days or maybe 60 days at the latest. But when that app comes out, the prices are going to go up because we've made significant investments in building this new technology. But for existing clients, the price will remain the same. So this is kind of one of the last chances for new clients to come on board, lock in current pricing, and get all of the benefits of this new app and the new technology that we're rolling out. So it's one of the last opportunities to get on board before the new Invictus.ai product rolls out. And I wanted to share that with your audience before checking out.
Interesting kind of fusion of new technology and analysis on the markets.
Well, I think so. I mean, the way that most Wall Street research works is that an investment firm will have a relationship with the bank. And if they read a report and they think it's interesting, they can call the analyst and get more information. Mm-hmm. Retail investors really don't have that ability because there's just limitations to bank resources or even resources for smaller firms like me. But what the artificial intelligence will enable you to do is essentially have an analyst PM relationship with Invictus Research, because you can speak to the chatbot as though it's an analyst at Invictus, and it's trained on all the same research and will answer the same way. So it should be a really useful tool that enhances the customer experience significantly and makes it more like the experience that a professional money manager has with Wall Street.
Interesting. Of course, Mike, that's all available at invictus-research.com, right? Right.
It's at invictus-research.com. And if you're interested in following me on Twitter, my handle is @InvictusMacro.
Perfect. Mike, thanks so much for your time today.
My pleasure. Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.